If you have a HELOC, which is a home equity line of credit, so let's say you have a second position on a house and you're buying another house, you can actually use unused credit line as reserves. So let's say you have a $100,000 HELOC and you've only got $20,000 on it and there's $80,000 of unused credit line, that you can show that at that $80,000. Now, I don't know that all banks will accept this, but I know for Fannie Mae loans that it is considered an acceptable form.
Welcome back to The Broke Billionaires, where we document our daily struggles in building wealth while raising a young family. Join us as we talk creative wealth building for everyday people and couples that are struggling in a down economy. I'm Lauren.
And I'm Joshua Masari, and we'll be your hosts.
Hello.
What's your name?
I'm Lauren. What's your name?
Joshua. Should we introduce ourselves each time?
Yeah, probably saying hello.
Yeah. Okay.
Welcome to the show.
Welcome. All right. It's Thanksgiving Eve.
Oh, yeah.
The kids
Times have changed from when you were in your 20s, Thanksgiving Eve, right?
This used to be a
wild
going
night.
out night. It's I believe the
biggest going out
night of the year. Yeah.
Yeah.
Bad night to be on the roads.
Yeah.
But-
now you were laying in bed with our kids while I went through the In-N-Out drive-thru.
Yeah. So it's a wild Wednesday night.
Times have sure changed.
Kids are in bed. It's almost 10 o'clock, and here we are on the mic.
Here we are.
All right. So what are we talking about today?
All right. So tonight we are talking about getting mortgages. Dun, dun, dun.
Favorite topic.
So fun.
And I don't say that sarcastically. I actually really, really enjoy talking mortgages. I don't know why, but I could talk for hours with people
He's
about
not joking either.
getting mortgages. I don't know, because it's not an easy thing, at least for
Yeah.
us. It's being business owner, like a small business owner, self-employed, creatively building wealth through creative tax planning. It makes it very difficult on the flip side to get things like loans and
Mhm.
especially mortgages. So we've had to learn how to navigate that and get creative. And I've learned a lot of, well, both of us, but I think we've learned a lot of like ins and outs. I mean, you're a loan officer, you
Yeah.
are a licensed loan officer.
Yeah.
So, but I feel like a lot of the stuff that we end up doing is stuff that you never saw.
Yeah, it's not traditional things at all. It's very much outside of the box, and that's what I was going to say. Is it's tough for us, but I feel like even our friends and people we know that have kind of more stereotypical W-2 jobs, like they're kind of having trouble with loans as well. So there's some different kind of touch points on that. We'll get
Yeah,
into
and
tonight.
we're in a market right now that's more difficult. It's higher interest rate market, and the environment's just a lot more difficult. Banks are a lot tighter right now, and it's harder to get loans. So you do have to get a little more creative. It's just banks aren't as aggressive right now,
Yeah,
trying to give loans to everybody. So
yeah.
we'll go into some of the traditional options and some of the programs, like institutional programs, and then some of the more creative ways that you can buy a home.
Yeah. I think we kind of start from just the question we always get, or the thing we always hear is like, well, I don't have 20% down. Like we have a good income, we have great jobs, whatever it may be. But, at least in our market here with the housing prices being so high, people, that's the first thing they say is, we don't have 20% down. What would you tell them?
Yeah, I mean, to buy a fixer-upper around here, you have to have $250,000 if you're coming in with 20% down.
Yeah.
You definitely don't need 20% down. I think a lot of people know that, but surprisingly, not everybody. We've had a lot of people that didn't.
Very
They
surprised
just
by
like
that.
traditionally you had 20% down, and if that was just what you had to have to get a mortgage. But things have changed, and there's a lot of programs for first-time buyers. There's a lot of incentivized programs, and there's a lot of other ways to buy other than having 20% down, because with home prices, and it depends on your market too, but I mean, across the country, at 20% is just becoming a bigger and bigger portion of your wealth and harder to save. But you get in these higher price markets like California and New York and San Francisco and some of these other big cities. Just, I mean, anywhere, even Where I
Yeah.
come from in Oregon, it's just houses are expensive now. So
Yeah.
20% becomes it's
Much
not
larger
it's not
number.
chump change anymore.
Yeah,
And
definitely.
back in the 80s when our parents were buying houses,
oh
is
my gosh.
buy a house for, this house probably cost $200,000 back then. So all you had to do is come up with
Insane.
Yeah. 20% on that's a lot easier. So,
Yeah.
okay. So you do not need 20% down. There's a lot of programs to get around that. And then also, another question I get, or another, when you have a home that's your primary and then you want to buy a second home, that does actually require more down typically.
For an investment property,
For-
vacation
yeah, so
home,
if
like
you're
what kind
buying
of
it-
second?
If you're buying it as an investment property, a straight investment loan is going to require usually 25%, but there are some that will do 20%. But yeah, if you're just buying a property as a rental property, as an investment, straight investment, that's going to have a higher down payment always. But there's other ways to get around that. If you are buying a second home as a second home, with the intent of it, as long as it's on the application and the intent is that it's a secondary home, you can actually get it with 10% down. So there's a little bit of, differentiation between a second home and an investment home. So you do have that option as well.
Okay.
So we'll start by talking about the institutional loan programs, and that's going to be your bigger banks, your Chase, Wells Fargo, the credit unions, any type of big bank that's going to be doing loans. There's a lot of government programs out there or government-backed programs that are intended for people to help, buy a primary residence. A lot of them are first-time buyer, but not all of them. Some of them are just buying your primary. So we'll start with the basic, or I guess the most well-known or longest-standing one, which is FHA. I don't even know what FHA stands for.
Federal Housing Association.
Oh, yes. That's good. See, that's why we have the loan
Wow, I'm
officer.
surprised I pulled that out.
You
I
actually
haven't been
read
a loan officer in a while.
Oh, you actually
It's
passed
been
your test.
It's been a few years since I've practiced.
I probably knew that at one point, but it's been so long. So, okay. So FHA is a government-backed program for first-time home buyers. And you only need 3.5% down for the down payment portion, plus your closing costs. So you're probably looking at around 5% all in, depending on where you're at. But 3% is the actual down payment portion that's required.
It was administration, not association.
Oh, see?
I did mess it up. See,
Wow.
It's been a few years since I've done
Fail. Take your
I know.
license
Oh,
away.
shoot. It's not active currently, so
Can't take what you don't have then.
yeah, exactly.
Okay, so FHA has kind of a negative connotation about it, I think, kind of a negative stigma just because depends on the market, I suppose. In a hot market, nobody likes FHA loans because, from the seller's perspective, because it's a harder loan to close. So not that the people can't get approved, but there's a lot more that FHA requires on the home itself to be qualified. So
Right.
it's got to be a not perfect home. It doesn't have to be brand new and remodeled, but everything has to be working. All the appliances have to be 100% working. There can't be any paint or peeling
there
or
should
chipping. So a seller would have to scrape the paint and repaint and do all these things, make sure everything's working up to standards.
Yeah.
And it's to help, two reasons. One, to help these first-time home buyers get into a house that's not falling apart.
Right.
And also because the banks have a much higher risk on this because they it's on a higher LTV. So they're only getting 3.5% down. They want to make sure that if something happens and they have to foreclose on that home, they can turn around and sell it the next day.
Yeah,
So
it's ready to go.
yeah, so they can't have something. You can't buy a fixer-upper with an FHA loan. You can buy something that needs to be renovated, but it has to be in good, functional working order and up to standards. So a lot of people on the sell side, at least in a hot market, don't like the FHA, and that's going to deter them from taking an FHA offer just because there's usually a lot more things that have to be done in order, just because of the loan contingency. So in order to get that closed, there's a lot more stuff that has to be done. On the buyer side, you are going to have extra fees. You do have mortgage insurance, which is a lot more expensive than it used to be. When I bought that first home in California in 2011, I did buy that on an FHA. So I had 3.5% down plus closing costs. I think I was like, I don't know, it was under $20,000 to buy that first
Crazy.
home, which, yeah, it's crazy.
Yeah.
I bought that home for $400,000. It's now recently appraised for, it was about a year ago,
I was gonna say
1.2,
Yeah.
and the comps are up, so it's probably closer to 1.3 now.
Mhm.
So that $20,000 parlayed into over $1 million just right there.
Yeah.
So, so it's crazy. It's yeah. But we paid $400,000 for it. It's $900,000, almost $1 million in equity gain off that $20,000 purchase.
So crazy.
So FHA is kind of the long-standing first-time home buyer, and it's still there. It's not as prominent as it used to be because there's so many other programs that are more attractive to both buyers and sellers. But the FHA is still there and will probably always be there. So that is always a good option. And the other thing to think about is that even though you have the mortgage insurance, you can always get out. You can refinance. So let's say you buy it and a couple of years later you refinance it. That's actually what I did. Is I refinanced as the equity went up. I was able to refinance and drop the mortgage insurance.
Yeah.
So you can't, with an FHA, with a conventional loan, you can actually drop mortgage insurance by getting an appraisal done. And if the value is at 80%, they will just drop it. But with an FHA, I don't think you can drop it, or there's a much longer waiting period.
You have to refinance.
You have to refinance out of the loan to get out of that mortgage insurance. So there are some drawbacks to it, but it is for a first-time home buyer, especially with somebody that's got maybe limited income or limited funds for down payment. It is a really good loan to at least get you into a house.
Definitely.
Just a quick disclaimer. The information shared on this podcast is for informational purposes only and should not be considered as financial, tax, or legal advice. Always consult with a qualified professional before making any financial decisions. Your individual circumstances may differ and require specific strategies not discussed here. Now, let's get back to the show.
So there's a lot of other first-time buyer programs other than FHA. A lot of credit unions, a lot of them will have their own programs, but there's most of the credit unions, most banks will have some first-time buyer program. And I want to say they're usually around 5% down. So it's a little more down, but not that much more.
Do you think there's a benefit going with a bank versus a credit union? Like, what have you found?
I mean, money's money. Money's green wherever it comes from. So as long as you're buying a house and getting into it, doesn't really make a difference. But I will say that credit unions tend to be a little more friendly, a little more user friendly.
So usually it's more of like a mom and pop shop in a way, right? Like a little bit easier to communicate with.
They're community banks. They're community banks too. So they're not big, Wells Fargo, and you're talking to, you call them to apply and you're talking to somebody from Nebraska or from wherever. It's just a community. They're in each community. So ours here, Orange County, I think they got like maybe 5 or 6 locations, but they're just in Orange County. So you get, they're helping the community, and everyone that works there is from that area.
Yeah, I feel like you get to know the people there a little bit better, and they know the market better, and I don't know, it seems like we...
Yeah, I feel like that there's a little more connect there, where you have a bit of a disconnect from the bigger banks. But at the same time, I mean, especially for us, we'll take the money wherever we can get it sometimes.
Right. I think too, with, like coming from the other side of it and seeing, you want kind of that, not that connection, I'll say, because I mean, really a loan officer, someone working, is going to help the buyer as much as they can, right? Like they can, if you're in a not sticky situation, but if you're in an untraditional situation like we are, where we have a lot of like things we have to kind of talk through, you want someone that's going to take the time to like really look through your application and get to understand and know you as a borrower, and not just be another number on a desk. Yeah,
that makes sense. And I'll use this as an example. So at Orange County's credit union, we have there's a loan officer that I've been using since before I met you. She didn't do the purchase, but she did do. She was the one that actually told me that I could get the mortgage insurance removed by paying for an appraisal. So I did a HELOC, my first HELOC with her, and she gave me the appraisal and told me to take it to the lender, which I did, and I actually didn't have to pay for it because it was already part of the HELOC, and I got mortgage insurance dropped from that. So she is, over the years, she's given me a lot of like tips and tricks and different things that no one has ever taken the time to explain to
Yeah.
me. So I feel like every time I'm looking to do a new mortgage, I always call her first, whether
Mhm.
she can do it or not. She's also referred me to other credit unions and other banks that have programs. She knows everything everywhere that's going on.
Right.
So she's a really good source. Maybe we'll have her on here at some time because
Yeah.
she's really, really helpful and
It's
just
good to have
knows a
someone
lot.
like that you can kind of rely on and be a starting point at least.
Yeah. Yeah. So she and also kind of to your point, with somebody that kind of cares more about the community or the people they're working with. We had in 2019, it was 2019 or maybe early 2020 when we were trying to buy a house. That time it was, 30, 40 offers on each house and it was crazy. And I had just started my company a few years before that. So, self-employed, didn't have a whole lot of track record with the tax returns and everything because it was just a few years old. But, out of the box, it was a denial. There was no way I was going to get an approval, but she was like fighting for me, took it up the ladder, and she ended up going to the president of Orange County's credit union to get a special approval. It took a little longer. By the time it came back, it was like the house that we were trying to buy was long gone. But she actually took the time to run that up the ladder and get a special, approval from the president, just because it was, because of the rental income and business self-employed and all the tax write-offs and everything.
Yeah.
It was kind of like, well, they have the money to pay for it, but it's just on paper it didn't look great.
Right. So that's kind of what I meant is I think it's important to find someone, regardless of where they're at. If you have someone at a bigger institution, that's great. But I think these smaller kind of companies can be a little bit easier to work with in some capacities. At least if you're in, like I said, an entrepreneur, a business owner, and not traditional in your
the big banks tend to like the people that have the W-2 income and they fit in the box and it's a quick, easy approval.
So if you're not in the box, then
they don't like people out of the box. Tough. They don't like people like us.
No, we're their worst nightmare.
Yeah. Okay, so there's a lot of first-time buyer programs, and you just got to kind of call and shop around. But credit unions are a great place to start for that because they usually will have some pretty good programs, and they're easy to work with. One of the big credit unions, there's a few, but one of them that has really good mortgages, especially for first-time buyers, is Navy Federal Credit Union. And this girl at Orange County Credit Union had actually told me, if you don't have an account with them, get an account. And I was able to do that through, I've got two brothers. I was
going to say, you have to have someone.
Yeah. So I think I did it through my brother that was in the Air Force at the time. And he had an account and they were able to look him up.
So it can be a family member.
So it can be a family member. I think it has to be either like parents, maybe grandparents, siblings counted for me. I'm not sure what all the criteria is, but you do have to have someone that has served or currently serving to be able to give that account.
Okay.
But I opened an account just so in case we ever needed it for mortgages. So the next thing, so if you did serve, if you're a veteran or you're currently serving, there is the VA loan program, which is an incredible program for buying homes if you qualify for that. That's not something like maybe, or it just could be like next of kin. You have to actually have served or be a veteran yourself. But the way that works is you have entitlement that gives you a certain amount, and it changes based on where you live or where you're buying.
Mm-hmm.
The entitlement amount changes.
So the like median home price,
something like that. Yeah. But it's a pretty good program because you can buy with zero down. It's a little higher. You're leveraging it a little bit more, but you can buy a house with no money down. My brother's done that. He's bought a couple. So you can buy multiple houses. You can buy, you have to buy it as a primary, but you can buy
I was going to say, does that work for an investment property too? Or only
no, so you can buy it as a primary, but because the military is constantly moving people around, they restation you, then you got to move. You don't have a choice. So the way that works is you buy a house wherever you're stationed, and then if you get reassigned, you can keep that house and rent it out and then buy another one wherever you get moved to. So that with my brother, he
nice
was
way to start your portfolio.
Yeah. My brother was in El Paso, Texas and bought his when he was stationed there. And then they sent him to, I don't remember what
Germany?
No, he was in Germany before that.
Oh, Korea.
Yeah, he was on the border of I think North and South Korea. He's like right there on the border.
Was he really? I don't think I realized.
Yeah. I remember him sending pictures of like when they blew up that battery or something. There was some station they blew up, and he was like over in that area. But anyway, so he was overseas, so he started renting his house out, and then when he got home, he ended up leaving there. He was in for like 7 or 8 years. He ended up getting out of the Army, became a civilian, and went back to Oregon and bought a house there. As soon as he got a job, he bought a duplex, and he had enough entitlement left to be able to do another VA loan with 0 down. And he might have had to put a little down because I think his entitlement had run out. He didn't have enough entitlement to do.
So the entitlement's like a lump sum?
No,
or
it's hard to explain. It's not a lump sum. It's a sum. It is. So it's like $700,000 or whatever the amount is.
Okay.
And that's the part that is backed by VA, or that's the VA portion of the loan that you can get 0% on. So once you go beyond that, you have to, at that point, you have to have a down payment on the additional amount.
So say
that.
700,000 for however many homes, or
it's for all your homes combined.
For all your
correct.
homes. Okay.
Yeah.
Got it.
So he had run out and had
that.
to put a little bit down to make up the difference.
Okay.
But he bought that as a primary, lived in one side, rented the other side out, and that's where he's at now. What he's looking to do is another one now. And he still has a VA loan on the first one, so he would have to refinance that to free up entitlement if he's going to do it again. Yeah. Okay, so VA loans. Okay, so here's another an interesting one that actually my brother brought to my attention recently. It's called a Vendy loan. Not very many people know about these.
Yeah, I don't even think you've told me about this one.
There's a website. It's a Vendy website. It's VENDEE. That's what it's called. It's a Vendy loan. And what that means is that it was a VA loan that got repossessed. So somebody forecloses on a VA loan. It goes back into, not all of them go into this program, but the Vendy is basically, it's like they call it a seller finance, but you basically can buy these. You don't have to be a veteran. Anybody can buy them.
Okay.
I believe it's 5% down, and you get, I think it's not normal interest rates. So it's not a loan assumption, but I think it's a lower rate than what's currently out there.
Oh,
I believe
is how it works. Told me about this.
Yeah, it's kind of it's new to me, so
okay.
I don't know a whole lot about it.
So there's like a database you can go onto to see like.
Yeah, there's a Vendy website that has, and not all of them qualify for it, but it's if they do, then they qualify for this seller finance from the bank. It's not seller finance, but they call it seller finance because it's coming from the bank. So the bank forecloses it and basically says, instead of selling it at an auction, we're going to have somebody else just come in and take this property, and we'll just write a loan in their name. I don't understand everything about it, but it's an interesting problem for us. That they don't have, they don't exist around here.
Doesn't sound like it exists here.
So our market doesn't have these, but there's a lot of other markets that do have these, and they'll pop up. I've seen a couple in California, but it's like
are they near like nowhere. I was gonna say, are they near like the bases, or
maybe I don't know. It was like towns I'd never heard of. So. So the Vendy program, that's a new one, but that's an interesting one to watch, especially if those pop up in a market that you're in. So definitely, if you can find one of those, to be able to buy it with 5. Okay, so this is a way of getting around the 20 to 25% as an investor, because normally when you buy an investment loan, banks are going to require 20 or 25%. This is one exception where you can buy.
Even as an investment property.
You can buy an investment property, so you don't have to move into it and have it as a primary. You can buy it and start renting out day one.
Okay.
And the bank knows about it, and you can get it with 5% down. So that's
that's awesome.
Yeah.
Of course, they don't exist here.
If they did, there'd be like thousands of people fighting.
Yeah, exactly.
Yeah. Okay. So another trick on the VA. Well, actually, VA and FHA. There are these are what are called assumable loans. So what that means is somebody can sell, if they've got a VA loan or an FHA loan, they can sell their property and sell it with a loan assumption, meaning that somebody would, instead of getting their own loan, they would just take over the existing loan that's in place.
Okay.
So it transfers over to the new owner. It's not a subject to, it transfers over to the new buyers, the whole loan, in the exact terms and everything that the original owner had. So the exact interest rate, the exact term length. So let's say that somebody bought a home a few years ago on a 30-year mortgage. They've had it for 2 years. They've got 28 years left on it. So when you assume one of those loans, you're not assuming a 30-year loan, you're assuming a 28-year loan or 28 years left on it. So that is a really good way, especially if somebody bought it, in the last few years when interest rates were really low. Now we're in a higher interest rate market. That's a really good way to get a lower rate. So we're starting to see.
And anyone can buy these?
Anybody, yeah. So if it's a VA loan, you do not have to be a veteran to assume that loan.
Okay.
But I believe, and I'm not 100% sure, but I believe if you assume it as a civilian, that the entitlement may actually still be tied up.
That sounds familiar. I feel like
somebody recently brought that to my attention on a forum or something, and I wasn't aware of that, but I think that veteran that had that loan in place originally still ties up their entitlement until that loan gets refinanced. So that is one drawback, at least on the VA side of doing that, is that because the VA loan that's in place requires entitlement, when somebody that's not a veteran assumes that and doesn't have their own entitlement, that the entitlement still has to be used up towards that loan.
Okay.
So that person's entitlement would still be tied up. So they potentially couldn't buy another home unless they only had one and they still had enough to buy something. But whatever amount of entitlement was used for that initial loan, that is going to stay tied up until that loan is either paid off or refinanced.
Okay.
So that's one drawback for the seller in a case like that. But with an FHA, the FHA would just transfer over to new. Now, you can't just walk in and just get it. You still have to qualify. Same with the Vendy. You still have to qualify for the loan with your DTI. So you still have to buy it based on your personal income and everything.
So like us being an out-of-the-box kind of couple, would that work for these two situations?
It would be easier, but you still have to qualify for it. So with an FHA, though, being a loan assumption, I'm not 100% sure on this because I've never done one, but it might have to be you might have to be a first-time buyer because it is an FHA and you have to qualify for the loan in place. So I'm pretty sure you have to be a first-time buyer to be able to assume an FHA loan. Now, an FHA loan, you don't have to be an actual first-time buyer, but because I've done multiple FHA loans in my lifetime, you have to not have a current FHA loan, and you have to have not used the program in the last 2 years. So if you've had an FHA loan and then you either refinance it or you sell that property, and there's a 2-year waiting period after that 2 year. This may be different, but I remember when I was looking at it, this is what the loan programs were.
Yeah.
So after that 2-year waiting period, you were then eligible for a first-time home buyer.
Yeah.
FHA loan again. But yeah, just keep that in mind. You do have to qualify with your personal DTI on these. So, so with a loan assumption, though, you actually don't put any money down at all because you're just assuming the loan that's already in place.
So you're just taking over the next mortgage.
You're just taking over the loan, whatever their payment, everything, just taking it over exactly how it is.
But not like a seller finance where you're paying any sort of down. Well, I guess that was more like the.
So
V's,
okay, so here's the thing with this. They've already put their down payment on an FHA. They've already done their down payment.
Right.
On the VA loan. They probably didn't have a down payment. It depends how much equity they have. If they have equity, then the seller's probably going to want you to pay them their equity, and that's how you get into it. So let's say somebody has a house that's worth $1 million, but they bought it 2 years ago for $800,000, and let's just say they owe $800,000 on it. There's $200,000 of equity. They're going to want their equity, so you would actually have to pay the seller for that equity.
Got it.
So it could end up, it may, just because you can assume a loan doesn't mean it's going to be a good
So
deal.
yeah, it's really about finding the right one. It's
Yeah.
not just
Yeah. So if you find somebody
Finding
that just
time.
bought it a year ago and they, bought it for 800 and it's worth 800 today, there's no equity, then you could potentially
Yeah.
get that for $0 down.
okay.
But if they have $200,000 in equity, they're going to want that. Either you're going to have to come up with cash for it, or, that, I don't know on an assumption, but in a lot of other loans, the seller could opt to do a seller finance on that portion, on the equity. I don't see why you couldn't do it on a loan assumption,
Yeah.
but that's really up to the seller. But they could do a loan, like a second position loan for that equity,
Okay.
and write it that way. So that way you're still not having to come up with money down, but you are having to pay on that equity portion. But that's another way of buying a house without having to have the standard 20% down.
Okay. Lots of good options there.
Hey guys, if you're finding value or just want to follow along on our journey, make sure to hit that like button and subscribe. That would help us tremendously. You can also follow us on Instagram at The Broke Millionaires and be sure to share with your friends. Now let's get back to the show.
Okay, so there's one more that is kind of more recent, and this is something that government programs are starting to do. California did this earlier last year, and I think it was called Home for Everybody or something like that.
That sounds familiar. Mhm.
That was the name of the program in California. But the government came up with this program. It was for first-time buyers, and it was to help with the down payment. It's kind of like a down payment assist program, but basically they were offering up to 20% cash towards your down payment, and you didn't have to pay it back. There was no,
What's the
well, I shouldn't say you didn't have to pay it back. There was no payments on it or anything like that. Basically, they were purchasing a portion of the equity.
Okay.
So California was saying, hey, we'll give you 20% down for your $1 million home. So we'll give you $200,000. I had a max. I think $200,000 was the max,
yeah.
something like that. But we'll give you $200,000 to buy your home. You don't have to have any down payment money. We'll cover it. But we're going to own 20% of the equity. And I think the government was kind of realizing there's a lot of people becoming millionaires because of housing value, especially in California. Like, it's just such a strong appreciation market. I think they realized that they could probably capitalize on that.
Yeah.
But it was like, okay, we'll give you $200,000 for 20% in this home that's worth $1 million today. You don't have to worry about paying it back unless you refinance or sell the home. So somebody sells the home 10 years later, 5 years later, whatever it is. There was no term length.
Okay.
But at that point, when the home was sold or refinanced, whatever the value is at that time, state of California owned 20% of that, so they would get their cut. So they would be making money on all the
And this
equity
is a new
gain.
program, you said?
This came out last year, and I think with it had, I don't know how many millions of dollars allocated to this program, but it was completely gone within days. I don't know.
Oh,
It
wow.
just got flooded with applications,
Oh
and
my gosh.
within a week it was like completely used up, and
Okay.
it was gone. So that people were definitely aware of that
Yeah.
and taking advantage of it. But we're starting to see more of that type of buying. There's banks that are also doing second and third position liens, buying equity, and we'll talk about that later. But that's definitely another way to be able to buy a house, even though you don't own 100% of it.
Mm-hmm.
You now own 80% of something that you didn't have before. So without your money, and then you're still gaining equity because you own 80% of it. So on that appreciation, 80% of that is yours, and you're making a return on $0. So
Yeah.
it's like an infinite return. So that is if you can get into one of those programs, that's a really good way to start out if you haven't.
Do
bought
they
a
ever
first
bring
home.
these programs back, or is it kind of like a one-time thing?
Well, it's a one-time thing each time they do it because they take taxpayer dollars to do this, and they have to allocate a certain amount to it. And once that passes and gets into legislation, then it's a set amount of money. So once it's gone, it's gone. So I imagine we might see that again, or they might reallocate more money to it,
Mm-hmm.
or there may be a new program with new rules and something like that comes out. But I think we'll probably see more of that because I think the government's starting to realize that they can capitalize on this appreciation in areas like California. I don't know if they have these programs everywhere, but especially in a high appreciation market, it probably makes sense for the government to capitalize on some of that.
Makes sense. All right. You want to talk about required reserves?
Okay, yeah. So when you're getting a loan from an institutional loan, there's some requirements that are going to be part of your application that you need to be able to meet. One of them is going to be DTI, so your debt to income ratio. Basically, what that means is how much debt you have plus this new mortgage that you're taking on. Then they take all your income, and then it's the debt to income ratio. So it's a ratio basically to figure out, can you afford this mortgage that you're applying for? And they like to see 40% is usually the number they want to be under. A lot of banks will go like 43 or 45, but 40% or under is what they like to see the DTI come in at. The other part of that requirement or another requirement is going to be your cash reserves. This varies by bank. I think some programs like the FHA program, I think is a set amount of reserves regardless, but any other type of conventional loan is going to be kind of bank specific. But they usually like to see like 6 to 12 months of reserves, just cash in your bank. And it doesn't have to be cash, but they like to see reserves to be able to make that payment. So if you lose your job the next day after they close, they want to make sure you can make the payment for the next 6 to 12 months while you're looking for another job in that time. So what can you use as reserves? So obviously cash is one, but you can also use retirement accounts. So if you've got money in a retirement account, they will look at that. So when you're submitting your proof of funds, you can use a retirement account that's got in stocks or mutual funds or whatever it be. You can submit the statements from that. Most banks will take it. I know FHA, like an FHA guideline says that that's acceptable, but most banks will accept retirement accounts as reserve accounts. Another one, actually, this was a tip that I got from the contact at the credit union. She had said, and this is actually, I believe, directly from the Fannie Mae website, that if you have a HELOC, which is a home equity line of credit, so let's say you have a second position on a house and you're buying another house, you can actually use unused credit line as reserves. So let's say you have a $100,000 HELOC and you've only got $20,000 on it and there's $80,000 of unused credit line, that you can show that at that $80,000. Now, I don't know that all banks will accept this, but I know for Fannie Mae loans that it is considered an acceptable form of reserve. So because you can technically draw on that, and if you need to make a mortgage payment, you can draw on that money for anything you need and make your mortgage payment, pay your bills, whatever. So unused credit line. And I don't know if any credit line qualifies or if it's just a HELOC. I think a HELOC is a little more stable because it's an asset-based loan. And so you're less likely to lose that. They can't just take that away like a regular credit line will go up and down, whereas a HELOC is a little more set. It's a lien on the property. They can't just take a credit line away, at least I don't think. I think it's a lot more stable than a regular line credit. So it may have to be a HELOC in order to be able to use that, but that is a form of reserve that you can use. So a lot of people don't know that. I didn't know that till recently.
Yeah, I didn't realize that. Let's kind of talk about how creative tax planning, how can that hurt your chances of getting a loan?
All right. So, and we're going to go into full episodes on creative tax planning because that's probably do multiple episodes on that, but that's a whole nother animal. Creative tax planning is lowering your taxable income so that your adjusted your AGI, your adjustable gross income, is a lower amount so that you fall into a smaller tax bracket and you're just paying less overall taxes. So it's a great way to build wealth because you're giving less to taxes and keeping more of your money. So it's a good thing all around until you try to apply for a loan. Because most banks are going to look at your tax return and they look at your AGI, and because you have all these write-offs and your taxable income was less, they're going to take that lower number, and that's what they're going to use towards your DTI. There are some add backs. Usually banks will add back things like 401k contributions. I don't know what else. I mean, with us with a business, there's a lot of rights. There's a lot of depreciation. So when you have multiple properties and you've got rental properties, you depreciate them, and a lot of banks will add back depreciation because that's not an actual hard cost. Also, I will say that credit unions are a lot easier to work with when it comes to add backs for your debt to income. So trying to get depreciation, different things added back, a credit union is going to be a lot easier to work with on getting some. So if you have if you're a business owner, self-employed, it's going to be really hard just going to Wells Fargo to get these type of exceptions. So definitely credit union is going to be easier to work with, but this can hurt you when you go to get a loan. If you're a creative tax planner and you take all these write-offs and you save a bunch of money on taxes, you're going to pay for it when you try to get a loan. So it doesn't mean you can't get a loan. It just makes it a little more difficult, which
So is it worth it, do you think?
That's a good question.
Ooh, did I stump you?
Well, I've thought about do I just pay the taxes, get the loan,
then it's just
and then
easier?
go back and refile for that year to get the money back, which I think that's probably
our taxes are so
not legal,
involved.
so I haven't done that. But
that sounds like a headache.
yeah. So I feel like 2021 we had a really good year on paper for taxes because didn't quite have as many write-offs. Didn't have a lot of overhead with the business. So there was a lot of profit. We paid for it in taxes. That was a big tax bill. It took us a couple of years to pay that one off because it was a big tax bill.
Yeah.
But we rode that tax year for our loans until we filed 2023, which we just did. So we rode that for a couple of years on all the loans just because it was such a high tax year. And when you're self-employed, they take your 2 most recent tax years and then take the average of it. So that year we had that tax return, the one before, and averaged it out. Then the following year, it was the following year that had a bunch more write-offs, and then that previous year, and then averaged it out. And then once we got into 2023, now we're in a down economy. We're down, business is down. Now we don't have that to fall back on, so now we're kind of screwed.
Yeah, that's actually a good segue into kind of alternative loans for the self-employed.
Yeah. So when you get into a situation like that where it's really hard to get a loan,
which we've been in many, many times.
Yeah. There's other loans that are not as maybe attractive, maybe not as good of interest rates, or they might be more difficult to get, but there are other ways of getting mortgages without having to use your tax return. Because there are a lot of banks, smaller banks, credit unions, and these programs that are out there that understand self-employed people and understand the write-offs and the depreciation.
That's what I think it is too sometimes, is people just don't understand. You've had to so many times pick up the phone and explain and go through. When we're doing a loan application, how many documents are you sending? There's so many. And I think part of it is people, don't want to take the time, the underwriters and so forth don't want to take the time to look through it. But also, I don't know if they fully understand it sometimes. That's where, you were saying we don't fit in that box where other...
The loan officers definitely don't understand it.
No.
I've gotten to kind of down to a science. I put everything into a folder, and it's got subfolders for each of our incomes, and then all the different investments, and then the businesses and the tax returns for each entity. And so I'll send them this one folder, and it's just got all these folders, subfolders, and all this different income. And I think the loan officers aren't used to seeing that, so they get a little overwhelmed. Underwriters, they'll get down and they'll get to it.
True, yeah.
It's a lot more work, and I think it gets pushed to the bottom of the pile because they don't want to dig in and they just don't want to deal with it. But yeah, our tax returns, I think most people's tax returns are probably 20 or 30 pages at the most, and ours is well over 100 each year. So when they ask for the whole thing, I'm like, you sure you want the whole thing? I don't think I can send this in an email.
Yeah, exactly. How big is your system to take this?
I gotta zip it and put it in the cloud because it's so big. Or if people ask for a printout of it, I'm like, you sure you don't just want the first page? Because I'll give it to you, but I gotta load the printer up with more paper. So there are a lot of other ways. So one of them is a bank statement loan. And I haven't done this for a mortgage, but I did do it for a line of credit for one of my businesses. So a bank statement loan is a loan, either a mortgage or line of credit, where they use your statements for your income. So they don't look at your tax return. They just look at over the last 12 months what all your deposits into your account were for your business. Or if it's your mortgage, they'll do your business and your personal. They just look at all of your deposits. They take that number. I think every bank does it a little differently, but typically they'll just say, here's your gross deposits for the last 12 months. And they'll divide that by 2 or 50%. So they'll say, we're going to assume that your business had a 50% cost basis or 50% expenses. And so you only had 50% income on that. And then they divide that by 12 to give you your monthly income. And then they can use that for your DTI.
Okay.
So it's a lot easier for small business owners to get around the tax return, especially if you're creative on your tax planning and you've got a lot of write-offs and depreciation and things like that. It's a way to get around that and still capitalize on your gross. Like if you have high gross income for your business, it's a way to be able to utilize that for your approval. And a lot of times it works in your favor because, some business, it just depends on your business, but a lot of businesses may not have 50%, their expenses may be a lot higher. Like for my business, it's a lot higher than that.
Right.
I'm not making 50% on all my orders. I mean, great if I was, but they automatically, it's just like a standard set, the equation that they use, and they just take 50% as your expenses. So for me, when they do that, it actually looks better than how it really is because of the formula that they use is higher than what my actual gross income or my net profit would look like. So that's one way. That the downside of that is on a mortgage, it's typically going to be a little higher interest rate. Not a lot, but it's usually like maybe 0.5 point or a point higher. So you might end up paying a little more on the interest, but it's a loan that you might be able to get that you wouldn't otherwise be able to, get normally. And I think they're not going to have first-time buyer programs with 5% or 3% down, but I think you can still get a loan that way with like 10% down. So you're getting around the 20%, and you can still buy like a primary residence with only 10% down. Awesome. An investment property, they're probably going to require 20-25% on that, but you can at least buy a primary without the 20%. Another one. Okay, so here's another one that is a little new to me. I was told this by a broker that I was working with a couple of years ago. I think it was earlier last year. It was a new program that just came out, and I know banks are starting to do this more, but it's called an asset-based loan. Some banks call it a community mortgage. I think they all have their own name for this program, but it's kind of universally known. I think Rocket Mortgage actually does these too. So everybody's kind of starting to do this because there are so many people these days that don't fit in the box, just with small business owners and investors, and it's just becoming a bigger need. So an asset-based loan is basically instead of using income, they don't use your income or tax returns. The income portion, they use your assets. And they'll take whatever your assets are, and there's a formula. And I don't know, I have not done one of these loans, so I don't know the exact equation, but they basically look at whatever you have built up in your assets, and then they divide that by 12 or however they're going to do that, and they figure out what your income is going to be based on your assets. So, and I know that they do these. I don't know if you can get one with less than 20% down. They may have a 10% option. I'm not real sure. I think it is a higher risk loan, so I think they're probably going to require 20% down on these. I think from the ones I saw, but it's a way for those business owners to get around the issue of tax returns not being enough to qualify with your DTI. I don't know what all they'll accept. I think every bank's a little different.
In terms of assets.
Yeah, and there might be a little bit of leeway on that. I know, like, obviously cash and stocks are going to be the preferred ones, but, for somebody that's a business owner or an investor or like, retirement accounts, but, our retirement account's mostly real estate.
Yeah.
And we'll get into that in another episode, but I don't know how they're going to look at that because it's not a traditional retirement account with just cash and stocks or mutual funds. We have a little bit of that, but the majority of it owns, family homes and apartment buildings and, big development projects. And it's all in actual real estate. So I don't know how they would view that. We still have a statement that shows the amount and everything, but every bank's going to be different on how they view that stuff. So it just kind of depends on who you're applying with. But that is a newer loan program that we have not done, but that is a way to get around the income issue.
Okay.
Then I actually just heard about this one, so I don't know how accurate this is or how this works or who accepts this, but I've heard, and I think this is if you're retired and on a fixed income or just don't have a job. How do you get a loan if you don't have a job? That's really hard. So if you don't have, one of the ways is this asset-based loan if you have a lot of assets to work from. But if you don't have a business and you have no income right now, how do you get a loan? There's a way. Let's say you have cash, but you don't have a loan, you can set up a trust account and set up automatic disbursements to you from that trust account. And I believe from what I've read, you only need to show 3 months worth of disbursements being made. And the bank is going to want to see, I think 36 months was sounds like what the banks look for is they want to make sure there's enough money in that trust account to make that disbursement amount for 36 months.
Okay.
So if you have a lump sum of cash that you just inherited or you've got saved up or maybe you sold a property or somehow have a bunch of cash laying around, so you have money for a down payment, but you can't get a loan because you don't have a job right now. So you can actually create an income using a trust account with a fixed disbursement amount. So that's, again, I have not done that. It's not something that we've done on any of our purchases, but that was something that I recently learned and I think it's common with people that are retired and don't have, you've got your 401k or maybe whatever your pension, whatever you're drawing on, which is a fixed income, but that may not be enough to qualify. So people that have money will create a trust and set one of these up to create an additional source of income that's documentable and be able to use that to qualify for loans.
Huh.
So another little trick. Yeah, that's a new one that I recently learned.
Yeah, I've not heard of that one.
Let's kind of talk a little bit about creative financing, which we've done with just this property that we're in now, but kind of talk through the different options and what creative finance can look like.
So creative finance is the real fun one because you can get real creative with it. We'll probably go into this in more depth later. I feel like just the creative finance is a whole episode in itself. But just kind of a quick overview and some of the things that we've done. So creative finance is going to be anything that's outside of that institutional lending or outside of any private banks. Outside of private lending, so you got institutional lending, and then you've got the private lending, and then you've got like hard money loans, which is still considered private money. But just that's more for investment. So if you're looking to buy an investment property that needs to be renovated, you're doing it as a flip, or if you're going to fix and hold, you can get hard money loans and not have to worry about getting qualified with your income because they don't look at income. They just look at the asset, but they're not going to lend as much. They're going to usually do like 65 or 70% of the ARV. So they will go off of what the ARV, like what the after repair value is going to be. But a lot of times you're going to have to come up with 20 to 30% on those. Sometimes you can get better terms, especially if you're experienced and you've done a lot of these, but just starting out, it's going to
require. And the rate's usually really high on those too.
You're going to
right?
it's a short loan. Usually it's like 12 months on a lot of those loans. And it's going to be a much higher rate. You're looking at, 8, 9, 10, sometimes even higher than that.
Yeah.
So definitely not favorable, but it's just a short-term loan to get you into something until you either flip it or you're able to get it rented, stabilized, and then you refinance into a DSCR 30-year or something like that. Okay, so seller finance is going to be when there's no bank involved at all. You're just dealing directly.
Which I feel like that probably scares some people when they hear that. Like, how is that legal? How does that work?
Well, it's definitely not illegal. It's seller finance has been around probably longer than institutional lending.
Yeah.
I mean, that's probably how people
Used to
bought
do
and sold
it.
properties. Yeah, way back when. So it's not as common. I don't know why.
I know. I mean, and think about it. The property that we bought, it was not advertised as a seller finance, which I feel like is the case, right?
Yes,
so unless you know about it, I mean, we had to ask, and we didn't even ask till we were kind of partway through the process. Really, it kind of occurred to us to just kind of throw it out there and
Yeah, because we kind of got
see.
stuck. There was some more expenses that popped up, and the deal started to make less and less sense with the loan that we were doing, because we were doing a private money loan, and it was going to be a really, really expensive loan. The interest rate, the points, it was going to be really, really expensive. And it just got to the point where it didn't make sense. So we just threw it out there and said, hey, this is not making sense. We like the house. We want to make this happen. But I think I don't remember what it was. It was some repair, like a roof that needed repaired or something that popped up. And it was like, hey, we asked them if they would repair it, and they said no. I'm like, okay. And then, we
what do you
came
think about seller finance?
Yeah, so we came back to them and said, hey, look, we want the house. It's just getting too expensive. And with these extra repairs, it's not going to fit in the budget. We can't really do this. And I remember having this conversation with the sellers. And I was like, look, the only way, I'm like, I don't even know if you're open to this, but the only way I can see this actually going through is if you guys were able to do or willing to do a seller finance. And I remember the phone was just like dead silent. I was like,
remember that? I was like,
did I
oh,
piss them off or what just
yeah,
happened?
it's so quiet.
It was just like dead quiet for what seemed like a long time. I mean, it was probably a good 20, 30 seconds, but it seemed like,
that always seems
like 5 minutes. Yeah, it was so, I was like, did I just make it mad, or is he thinking about it? What's going on? And he kind of goes, we might consider that. I was like, oh, so you're saying there's a chance.
What the?
And his response was like, well,
wasn't it like what terms? Because
he was like, well, what kind of, he was like, well, what kind of term? He's like, oh, we wouldn't do it with 0% down. So I think what had happened was, I think because this was a FSBO, it was a for sale by owner, listed on Zillow,
which, do you remember it was listed for like a partial date? Because remember we saw it and we tried to go back and find it and we couldn't find it.
No, I think why we couldn't find it is because when you do it for sale by owner on Zillow, it doesn't show up with all the other homes. You have to go into that setting and turn it to for sale by owner. And we didn't realize that.
So I thought there was some other reason.
No, I think because I found that out afterwards. The reason it didn't show up.
We couldn't find the phone number. Remember, I had to go drive around.
It was a wrong phone number.
Yeah. I had to go drive around and try and find. Yeah, that was a
so
thing.
So just a quick aside, we use this software called PropStream, and it's $100 a month, and it gives you a lot of quick, easy data on buying homes that you wouldn't normally be able to get. So we were able to use that and skip trace the owners and found a phone number in Florida.
I just called it.
Yeah, the guy answered, and actually it was the owner.
Like, yeah, it was my mom's house.
Yeah. So this was a trust sale. But anyway, he said, what, we wouldn't do it for 0 down. And so, I think he might have said something later on, but I think a lot of people were trying to offer, because of for sale by owner, they're like, oh, we'll see if they'll do, seller finance. And people were just offering no money down or very little money down. And I don't think they necessarily needed the money.
I was going to say, they were also very against selling it to like flippers. Like they really, do you remember that? Like,
well, I don't know if it's that they were against it. No, I think it's because the offers were coming in lower than what they had a set amount of money they wanted to make on the house. And that was kind of that's why they didn't have a realtor, because a realtor was going to take $100,000 and they couldn't get enough to cover what they wanted plus the realtor fees.
Yeah.
This house was half demoed when we bought it because there was a flood And so it was not something that somebody could buy with institutional lending because the house was already half demoed.
No way it would have.
And so it kind of needed a special buyer. And we just happened to be those special people that were willing to take it on.
So special.
But yeah, so they said, we wouldn't do it for zero down. And I'm like, yeah, that's fine. What are you thinking? What would you need down? And he came back and said, well, we wouldn't do it for less than 10% down. And that was going to be less than what we were doing with the other loans. So I was like, yeah, that's fair. We got the money. We can do it. And, I even threw out there, I'm like, we could do a balloon. However long you guys, you're the bank, you tell us what you want to do. And he said, what kind of interest rate? I'm like, I don't know. We can just Google whatever current rates are right now.
Yeah.
And I think at the time they were like 6.5% or something like that. And I told him that, and he said he wanted to talk to his sister and he'd get back to me. And I think it was like over the weekend, and we didn't hear from him for like 3 days. So we were getting nervous.
Yeah.
and then like on a Monday or Tuesday, he called and said that he talked over with her and they'd be willing to do it with 10% down, and which is still a decent amount of money. And I think that they needed a little bit of money, but I don't think they needed all the money. So it wasn't a huge deal. They're probably just going to put the money in investments or into retirement or something anyway. So they came back with 6% interest only for 5 years, which at the time and still today, that's a really good loan. You can't, and rates haven't come down to that yet. So for us, that was a really good loan, and it was an easy loan to get into. So here's the thing, the seller finance. Usually seller finance, so they say with seller finance it's either my price, your terms, or my terms, your price. So you can't have both, but you can get one or the other. They had a set price that they wanted for the house, so they were stuck. And so I will say this. I even said, if you guys are willing to do seller finance, we would pay full asking, because we had negotiated down.
Right, I forgot about that.
They were originally asking 1.25, and I think we had them down to 1.225. So it was like $25,000 off the price. But I was willing to pay more, and I knew, knowing
terms were better.
Knowing that it was going to save us on the interest rate, and also because we were doing a loan that had the acquisition and the construction loan built into one. The construction loan was a lot more expensive, so it was bringing the average rate up. So we were going to have to refinance out of that pretty quickly right away. But knowing we were going to save on interest and points, we didn't have the origination fee. So the origination fee on the loan we were looking at was really high. So I knew we'd save on that as well, but I was willing to pay more for the house and spread that, because that's getting spread out over the loan. So it's not cash up front. So it was a lot easier for us to get into that way. So with seller finance, I didn't even do a credit check with them. I mean, obviously,
I was going to say they really just choose what they need to see, right?
So obviously we had an approval with the bank, so we'd already gone through that. So I think that probably helped. But they never asked for income or credit check or anything. The
no, and didn't you offer to have the attorney actually write up the loan?
So I actually used my attorney,
right,
and wrote the loan with this. He came over to my office several times, and we actually went through and we put the loan together ourselves. So
kind of I
kind of wrote the loan myself. I used this whole package that this attorney had online, and you just go, kind of plug and play. They're here in California, and so it was already a pre-drawn up document, and you just plug in all the information. And so we kind of went through it together and put it together. And I think it was like $400 you pay for this package to be able to put this together, and then he wanted to have the seller was also an attorney. This wasn't his specialty, but he was also an attorney. So he wanted to make sure everything was done correctly and reviewed. So we also paid the attorneys to review it, and I paid for all that. I think it was about $1,000, and I was willing to pay for that because it was cheaper than an origination fee from a lender. So it made sense to do that.
Would you say, because that was the first time we did seller financing, do you feel
it's not the first time we've done seller financing. It's the first time we've done seller financing on a primary residence.
Oh, that's true. Okay, well, hold on. Let me get back to my question here. So do you feel like it was easy enough for you because you're so knowledgeable in this, or do you feel like this is something that anyone could do?
I felt a lot more comfortable than they did with it because of my experience with it, and I already kind of knew where to go to get this done. Mm-hmm. So I think me being comfortable and knowing kind of taking the lead on it, I think that kind of helped put their mind at ease and kind of know that we weren't just going to run off of the property and not pay them or something. I think that kind of gave them a peace of mind.
Because I feel like that could scare people. Like, I don't even know how to start this process, or like, I wouldn't even know, really where to begin with it. But
Yeah. I think we'll go into this
Yeah.
more later because we could talk for a whole nother hour
That's
just
true.
on this. But yeah, so we did buy this on seller finance, and it worked out pretty good. And that again, that's not the first seller finance we've done. So there's other ways. So that's one example. And for the owners, we're paying them interest only almost. We're paying them almost $70,000 a year in interest that they're making on this property. So they're making money that they're going to get paid even more than they were going to
yeah.
collect on the house just selling it. So for them, it ended up being a really good deal. So
Yeah.
they're making money. They're happy. We are able to get into it, get it renovated, and then we'll refinance it. We have a 5-year balloon, so we have to refinance that. But it was a way for us to definitely get into it, and worked out for them too because they're making money on it, and we're making the payments, so they're happy and
Yeah.
everyone's happy. Okay, so another creative finance option is a subject to, and what the subject to means is that you are taking over an existing loan. You're buying a property subject to the existing loan, and what that means is you are basically taking over someone's payments. You are buying the house, so they are signing the deed over to you, but the loan stays in their name, and you just start making the payments. That's pretty much the gist of
Yeah.
what a subject to is, and we'll go into that more
one
in detail.
definitely
Yeah,
needs its
that
own
needs a little bit more description, but
episode. Yeah.
just a quick overview. That's what a subject to is. There's also what's called a wrap, which is similar to a subject to, but in a wrap, someone has a loan on a property. They turn around and they sell the house on a seller finance. So they are actually writing their own loan on the house, even though they still have a loan in their name. And so that's called a wrap because they're taking the existing loan, wrapping it with another loan and selling it to somebody else. And, the subject to, I've done a couple seller finance out of state. That the other one, the one we just did was the first one in California, but I've done seller finance before where I bought on seller finance. I've also done a subject to on a duplex that we own in Texas. And then I've also done a wrap on an apartment building that we own in Texas as well. So there's a lot more. There's a lot of other ways of acquiring properties creatively, but those are
we
kind
need
of
to do
some
a
of the,
whole other episode.
yeah,
on
those are kind of some of the that's a top line overview of those.
Yeah. Anything else you want to close out with for tonight?
No, I think that's a pretty good overview. I mean, I can talk about this stuff forever,
You
but
really can.
we gotta cut it off and break it up and save it for other episodes.
Yeah.
But yeah, so definitely there's a lot, if you're one of those people that thinks you need to save 20% to buy a house, like that's not the only way to buy a house.
Yeah.
Definitely more ways to do it. And just, again, with real estate for us, building wealth, there's different ways of doing it. We own businesses and we have a little bit in the stock market, but really real estate's what we are mostly vested in. So that's kind of what we're going to focus a lot on, but definitely a lot of ways to do that.
Yeah, absolutely.
All right. That's it. Are we going to do a book? Well, we should do a book.
Oh, yeah. Do you have any good books you've read lately?
Okay. So a good book, I'm going to, a good book for what we talked about today. The original host of Bigger Pockets podcast, Brandon Turner, and he wrote a book called, I don't even know what it's called. It's the most ridiculous title ever. It's like the longest title. It's like,
Really? I was going to say I haven't read
it's
this
like,
one.
I don't know, how to buy houses with zero and low money down or something like that. It's a really long, anyway, it's the first book he put out, but it is a good way to kind of get some initial knowledge on ways of buying houses, either creatively or by leveraging. And that's what we're going to talk about in our next episode is how to leverage existing properties into your next one. So without actually having to come up with cash, but still being able to cover the down payment. But that's a good beginner's book on how to invest without having 20% down. So I think that would be a good one for people.
That is a good one.
All right. That's it from me.
All right.
All right. Signing off.
Thanks for listening. This has been a production of Rebuilding the Dream Studios.